Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 8th of September 2019, and we're discussing China buying yet more gold to increase its reserves. China has been ramping up its gold reserves this year with a number of successive monthly increases. At the end of August, it held 62.45 million fine troy ounces of gold, up some 4.85% since the end of last year. The value of its gold reserves rose to $95.45 billion at the end of August from $87.87 billion at the end of July. Undoubtedly, there are a number of reasons for this, not least being that it wishes to hedge or protect itself against international tensions and trade tariffs. Also, interest rates are at derisory or negative levels, making bonds less attractive. And the real possibility that currency wars may actually break out. Now, this should be no surprise, as the World Gold Council recently reported, quote, in 2018 alone, central banks bought 651 tons of gold, up 74%. Compared to 2017 and the highest level since 1971, unquote. Now, before we all get too carried away with this, we have to bear in mind that the percentage of gold held in such reserves remains small compared to other assets and fiat currencies. China, for example, has total reserves of approximately $3 trillion worth, of which $95 billion worth is in gold, around 3%. Or put another way, 63,000 ounces. Also, to put this in perspective, for those who believe that China is on the verge of revaluing their gold so as to clear their debts, in July 2019, the Institute of International Finance reported that China's debt reached over $40 trillion. So this would mean that to clear its debt by utilizing all of the gold held by the People's Bank of China, gold would have to rise in value by just over 421 times to a little over $631,000 an ounce. But of course, for the time being, China does not control the world gold price, and despite its healthy holdings, cannot dictate that price. And even if it could, even the most ardent of pumpers would regard $631,000 gold as outrageous. Even, as a number have suggested, to back their currency 100%, that's M0 and M1, which includes cash and what can easily be converted to cash quickly, the gold value would have to increase to cater for the dollar equivalent of $8.5 trillion, as there are approximately 62 trillion yuan in circulation, which would necessitate a gold price of just under 90 times its current value, or $135,000 an ounce. So perhaps you can see why, even in yuan terms, with China being one of the most likely candidates to back their currency with gold, 100% is not going to happen, and certainly not soon. And even at a low rate of 20%, which many pumpers predict is about to happen any day, it could happen overnight, would still necessitate a $27,000 gold price. Simply not within the realms of current reality, at least. Now, it was reported only yesterday by Reuters that, quote, China's foreign exchange reserves rose unexpectedly in August, even as the yuan posted its biggest monthly drop in 25 years, amid escalating trade tensions with the United States. The country's foreign exchange reserves, the world's largest, rose by $3.5 billion in August to $3.1072 trillion, central bank data showed on Saturday, unquote. So, despite its gold holdings, the yuan tumbled about 3.8% against the dollar in August, its sharpest monthly drop since 1994. It's currently trading at 11.5-year lows. The yuan has now depreciated 12% against the dollar since the trade tariff dispute began back in April of last year. So with downward pressure on the economy increasing and China's exports unexpectedly falling by 1% in August compared with a year earlier, as shipments to the US slowed sharply, so some would argue the trade tariffs are working, China on Friday announced further cuts in banks' reserve requirements to free up more funds for lending. Analysts are also widely expecting modest interest rate cuts in mid-September, because growth is believed to be nearing the bottom end of the government's 6 to 6.5% full-year target range, after slowing to 6.2% in the second quarter, its weakest pace in at least 27 years. So, we currently have a falling yuan against a backdrop of increasing foreign currency and gold reserves, and the likelihood of even more credit being created and more money pumped into the economy, thereby potentially increasing even further the mountain any gold revaluation would have to stretch to in order to climb it. Now that said, some positive news for gold bulls. Philip Klapvich, Managing Director at consultancy Precious Metals Insights Limited, said before the PBOC's latest figures were released, quote, "It is important for the country to diversify away from the US dollar. Over the long run, even relatively small-scale gold purchases add up and help to meet this objective," unquote. And Ross Strachan, a senior commodities economist at Capital Economics, stated, quote, "This fits with China's well-established pattern of increasing gold reserves month after month, but not in a large enough volume to disrupt the gold market. We expect them to continue this trend as part of their long-term strategy to diversify their foreign exchange reserves," unquote. So, at its most simple, and we confess we are breaking this argument down to basics, China is faced with either continuing with its slow but steady accumulation of gold over the long term, which is what we believe is going to happen, or, as the pumpers would have you believe, revalue gold overnight so that it can repay all of its debts. We can all see that that is not an imminent solution. China's debt with the United States alone is estimated to be around $1 trillion, and for it to pay that off with current gold reserves at 100%, we would need to see gold rise 11 times to around $16,500 an ounce. And then what about the rest of its debt? Now, all that said, and this is where we state that we are bullish longer term for gold, regardless of short-term price rises and reductions, because we can recognize a trend. Central banks are buying more gold. China is increasing its reserves, as are a number of other countries, but frankly in slow measure. Now, with interest rates falling and likely to continue to fall, and over $13 trillion worth of bonds at the last count, and it's rising, are already offering zero or negative interest rates, the desire for gold will increase. So in conclusion, the tailwinds are behind gold for the medium to long term. The geopolitics is gold supportive. But please recognize that this is going to be a gradual process of economic power transfer from the West to the East. which will still take many years to accomplish. Thank you for listening, and do share your views. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.